There's a fear in the market, of course, and there's been that fear all year long. And as I mentioned, so a lot of the currencies have already fallen quite a lot. In order for them to fall a lot more, we're going to have then a bad crisis. And I just don't expect that to happen. So I do think that China, which is a big influence on all the emerging markets, is going to start stabilizing somewhat. That's going to have as much of a good impact to cushion any rate rise that might come out of the US. So some corporations that maybe have too much debt could run into a lot of problems, but it's unlikely to take a specific country and really cause a really deep recession. So at the moment, I don't think that the dollar strengthening is going to really crush the emerging markets as the story right now in the market. First of all, it's really important to remember that the emerging markets, like any other region, can be somewhat cyclical in nature. There are individual countries that are more export dependent and dependent on global trade, for instance, like Taiwan. However, structurally underneath, they're still continuing to grow. And one definitely has to take a little longer term viewpoint to the emerging markets. The other thing to remember is often just looking at the index going up and down is not what's happening at the company level. So China is a good example that there's a lot of good stocks and companies that are doing quite well that are going up in price, but it's getting hit by some of the larger companies that dominate the stock market indices. So by far and away, the best way to approach the emerging markets is from a stock picking type of environment. And personally, I still have money invested in the emerging markets, and when they go down, I tend to think a bit counterintuitive because I think the prices will over time continue to go back up. Another important point on the emerging markets is that when they have very high growth rates, generally the stock market doesn't perform very well. And when the growth rates start to come down, the stock markets tend to rise over history. And that's what's probably happening in China as well the next 3 to 5 years. What tends to happen in the real economy is that the capital is allocated a bit more efficiently to the places it should go to. And that has tended to work to the benefit of shareholders and hence stock prices. So when the economies are growing too quickly and credit is growing too quickly, the stock market kind of sees through this and doesn't work out too well. But there are many countries in the world that had very high rates of growth and bad stock markets. And the stock market started working when the growth rate started to fall. So stable is not 9-10%. Stable is more 3-4, maybe 5%. And that's what I think is likely in the long term to happen in China.